This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 22, 2026, and this is the New York pre-market. Now, let's get into it. Good evening. The market closed with a deceptive calm today, but beneath the surface, we're watching a classic fragmentation event unfold. The S&P 500 touched new territory, yet half the economy refused to participate. Let's look at the tape. Looking ahead to the immediate horizon, our calendar is relatively quiet for the broader indices, shifting the focus squarely to individual corporate movements. Tonight, we are tracking earnings from Aerospace, AutoZone, and AllianceBernstein. These aren't just box-checking reports. They are bellwethers for consumer discretionary spending power and capital markets liquidity respectively. As Apex noted earlier, with no major S&P 500 heavyweights reporting tomorrow, the market will likely let today's momentum dictate the overnight sentiment. If Aero or ALK miss expectations, it could validate the concerns about consumption slowing. A direct counterpoint to the AI-driven growth narrative we saw dominate the day. Here is the snapshot as of 16:34 ET today. The S&P 500, represented by SPY, finished the day at $748.28, gaining 0.83%. It's a solid number, but let's look closer. The Nasdaq Composite equivalent, QQQ, ran hotter, surging 1.85% to $708.97. The Dow Diamonds climbed modestly to $521.51. But the real story isn't the majors, it's the divergence. The Russell 2000, IWM, managed a 1.45% gain to $296.54, yet it failed to crack its 5-day high of $297.81. Meanwhile, the technology sector ETF, the technology sector, posted a massive 2.89% intraday jump to $180.78, even as it ended the week down 1.55%. And at the bottom of the pile, financials, the financial sector, barely moved, ticking up just 0.12% to $56.11. This is a market running on fumes, powered almost entirely by a single narrative.
And that narrative is SMCI. Let's talk about the mechanics here. We saw a 12.6% gap up in supermicro computer pre-market, accompanied by relative volume of 1.7 times normal. That is not organic accumulation, that is a momentum chase. In my analysis, when you see a single name catalyst driving 1.85% gains in QQQ, while the broader industrial sector, represented by the industrial sector at $178.66, is essentially flat, you have a liquidity vacuum. The capital isn't spreading, it's concentrating. Look at RPM. They reported a beat, up 6.5%, but it's an isolated event. Without follow-through from the broader industrials, the SMCI move feels less like a sector rotation and more like a speculative bubble inflating in real time.
It's worse than a bubble, CIPHER. It's a distraction. Look at the sentiment scores. NVDA has 76 bullish articles. AMD is glowing positive. But look at Meta, neutral sentiment, 30 articles. The narrative has shifted entirely from platform economics to hardware infrastructure. Retail is looking at SMCI chart, and institutions are quietly rotating out of the broader megacaps that don't have an AI suffix attached to them. The VIX is at 18.65, which screams complacency. The market isn't worried about the lack of breadth because the VIX is suppressing the fear response. But once that 7x volume dries up, the silence will be deafening.
Complacency is the risk pulse, but the structural damage is what keeps me up at night. You're talking about sentiment. I'm talking about the yield curve. The 10-year 2-year spread is flat at plus 37 basis points. That is a recessionary signal that the bond market is screaming. Yet the financial sector has gained a pathetic 0.12%. Banks are not pricing in a healthy credit environment. They are pricing in stagnation. And look at the small caps. IWM is at $296.54, stuck below its high. If the yield curve continues to flatten or invert further, the cost of capital for those small-cap firms becomes prohibitive. Today's rally is built on the assumption that rates stay benign. They aren't. Core PCE is still at 3.41%. The foundation is cracking, and everyone is just admiring the paint job on the server racks.
SPECTER raises a valid macro concern, but let's ground this in the actual price action, because the charts are telling us something different about timing. Grid, walk us through the SPY structure. We're at $748.28, approaching that $755.58 resistance from July 15th. Is that a breakout, or are we setting up for a double top?
It's a high-stakes pinch point apex. SPY has closed the 10-day range, which ran from $739.51 to $755.58. We are sitting right at the upper boundary. On the daily chart, that $755.58 level is the pivot. If we clear it with volume, which we didn't see broadly today only in SMCI, we extend the range. However, look at QQQ. It's at $708.97, which is 1.7% off its 10-day high of $726.39. The momentum is there, but the breadth isn't. The support level for QQQ is $702.80, the July 21 low. If we lose that, the 1.85% gain today evaporates. So, while the bias is upward towards $755.58, the technical structure is thin. There's very little cushion between the current price and the overhead supply nodes.
Thin is an understatement. You're looking at the top-level index, grid, but look at the component health. The technology sector is down 1.55% on the week despite today's pop. That tells me this is a short-covering bounce, not a trend reversal. The fundamental engine is cold. If you look at the earnings reports coming out tonight, Aero, ALK, if those guidance figures come in soft, that SMCI gap fill is going to reverse instantly. The technical breakout at $755.58 is predicated on the idea that earnings season is supportive. My data says it's not. It's fragile.
Exactly. And that's why the sentiment divergence is dangerous. Everyone is focused on the upside potential of SMCI, but the put/call ratios in the broader market are still skewed. Investors are hedging. They know that relying on a single stock to carry the S&P 500 is unsustainable. When the mood shifts, and it always does, the rotation won't be gradual. It'll be violent. The liquidity that flowed into SMCI is drying up, and it's not flowing back into the financial sector or IWM. It's vanishing. So, we have a technical breakout attempt at $755.58 for SPY, challenged by a lack of fundamental breadth and a flat yield curve. Let's dig deeper into the specific mechanics of the leader, QQQ, since it did the heavy lifting today.
On QQQ, the setup is tighter. We're at $708.97. The immediate resistance is that $726.39 high. To make that move effective, we need to see volume expand beyond today's levels. Right now, the volume is concentrated in SMCI. For QQQ to sustain a move towards $726, we need participation from the other heavy hitters. Currently, the 50% retracement of the last leg is roughly around the $700 mark, which acts as psychological support. If we dip below $702.80, the short-term trend flips. But as long as we hold $702.80, the path of least resistance remains toward testing $726.
Hold $702.80. That's optimistic given the macro backdrop. You're ignoring the VIX. At 18.65, we are in the lowest quartile of volatility for this quarter. Low volatility environments usually end with spikes. If QQQ touches $726 and gets rejected, which is likely given the flat curve, the drop back to $700 won't be gentle. It will be a stop run. The liquidity pools at $702.80 will be swept. SPECTER's warning stands. This is a distribution phase, not an accumulation phase.
I agree with SPECTER on the risk, but disagree on the mechanism. It's not just a stop run, it's a valuation reset. Look at the energy sector. Energy is up nearly 3% this week. Why? Because money is fleeing rate-sensitive tech and hiding in commodities. That's where the smart money is going. It's not sitting in triple Q waiting for $726. It's in the energy sector and gold. The capital flight is happening right now. And it's not visible in the SPY chart until it's too late.
That's a crucial distinction, CIPHER. Money isn't exiting equities entirely, it's rotating out of rate-sensitive growth and into hard assets or energy. This validates the narrow breadth argument. We aren't seeing a general rally, we're seeing a war between sectors. Apex here, the trade setup is clear. Long triple Q is a momentum play that is fighting the gravity of the yield curve. Shorting the financial sector is a value play that is fighting the inertia of the current price action. The middle ground is empty. I would advise staying on the sidelines until we see either the technology sector turn positive on the week or the financial sector confirm a breakout above $57.
Let's turn to the small cap complex. IWM closed at $296.54. It missed its high of $297.81. What does this tell us about risk appetite?
It tells us that the breakout failed. Technically, $297.81 is a confirmed resistance level. Repeated failures to clear a local high indicate increasing selling pressure. The next major support level on the 4-hour chart is the $292.68 low from earlier this month. If IWM falls below $296, we could see a quick retest of $292. The structure is bearish in the short term. The bulls tried to push it higher and they got rejected. That leaves a lot of trapped buyers above $297.
Trapped buyers, yes, but also a loss of confidence. The sentiment around small caps has deteriorated. When you combine the high cost of borrowing, remember that flat curve, with weak consumer data, small caps are the canaries in the coal mine. The fact that IWM is lagging SPY by such a wide margin means traders are abandoning risk. They want the safety of SPY or the speculation of SMCI. They don't want the balance sheet risk of the Russell 2000.
Abandoning is the right word. IWM is the perfect indicator of stress. While SPY makes new highs, IWM is making lower highs. That is a classic divergence. It means the underlying economy is weakening, but the index managers are propping up the big tech names to keep the indices green. Once they stop propping them up, and they will, the fall in IWM will accelerate. Watch for the VIX to tick above 19.5. That's the signal that the soft landing narrative is dying.
Finally, let's look at the sector rotation. The technology sector is up today but down for the week. The financial sector is flat. The energy sector is up. Where is the money actually going?
It's going to energy and healthcare. Look at the healthcare sector. It's up 0.63% to $160.25. Healthcare is defensive. It doesn't care about the yield curve. It doesn't care about AI hype. It cares about demographics. And energy, the energy sector at $58.50, is benefiting from geopolitical tension and supply constraints. The market is moving from growth at any cost to cash flow and scarcity. If you're holding tech, you're hoping for a reversal. If you're holding energy and healthcare, you're enjoying a hedge against the exact risks Grid and SPECTER are describing.
Technically, the energy sector breaking out above $58.50 confirms a sector rotation. If the technology sector fails to reclaim its 20-day moving average, which is trending down, that rotation becomes permanent. The relative strength ratio between the technology sector and the energy sector is flipping. That's a huge signal for quantitative models. The algorithmic flows are switching off tech and switching on energy.
This brings us to the core conclusion for the evening. We have a market at a crossroads. SPY is testing $755.58. Triple Q is pushing towards $726. Both are relying on the continued strength of a handful of AI names, but the breadth indicators, IWM, the financial sector, the technology sector weekly performance, are flashing red. The consensus among the desk is caution. The upside is capped by macro headwinds, and the downside risk is amplified by the lack of participation. The best course of action is to monitor the open. If SMCI gaps up again and fails to hold, that's the trigger for the mean reversion everyone is fearing. Until then, sit on hands. Don't chase the breakout. Let the market prove it wants to go higher before you commit capital.
Thank you to our team. Here are the key takeaways for the Equities edition. First, SPY is testing critical resistance at $755.58, but the lack of broad participation makes this level vulnerable. Second, the divergence between tech leadership and small-cap weakness is widening, with IWM struggling to break its recent high. Third, capital is rotating defensively into energy and healthcare, leaving rate-sensitive sectors like financials behind. Tomorrow, we watch the aftermath of today's earnings from Aero and ALK and see if the SMCI momentum can survive the open. Good trading, everyone. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.